Welcome to Bugan Tuitions. So this is the continuation of Principles of Accounts. In the previous video, we discussed the business environment where we learned about the accounting equation. In this video, we're going to start what is called a business transaction, and we're going to analyze how various business transactions affects the accounting equation. So we start with the definition of a business transaction. So a business transaction is defined as an exchange of goods or services for money. So whenever there is an exchange of goods or services for money, then a transaction or a business transaction has occurred. There are some cases where money is not involved, or maybe some payment facilities such as the bank are also not involved. It can be just the exchange of goods for goods. You give this person this thing, then you receive another thing that you want in exchange. There are also business transactions, though we won't be dealing with those in accounts. So here are some types of transactions. We're going to start with cash transaction, which is a transaction where there is an immediate transfer or payment of cash for goods or services. So whenever there's a transaction, a business transaction occurring, and there is cash involved, then that's a cash transaction. The second type of transaction is bank transaction, which basically is defined as a transaction in which the exchange of cash for goods or services is done through the bank or using a banking facility such as a check or a deposit slip. So the main difference between a cash transaction and a bank transaction is that in a cash transaction, cash is involved, while in a bank transaction, bank facilities are involved. The third type of transaction is credit transaction, which is a transaction in which goods supplied or services rendered against a promise given by the receiver of goods or services to pay at a future date. So simply, in this transaction, goods are going to be given to this person. Then this person will make a promise that they are going to make a payment in future. So the giver is going to receive a promise of the payment to be made in future, while the receiver is going to receive goods or services. That's a credit transaction. So there are some terms that you need to get acquainted with when it comes to credit transaction. First and foremost, in this case, the supplier of the goods or services is known as a creditor, while the receiver is known as a debtor. And the promise to pay at a later date is a date due and payable to the supplier. The other terminologies that you might come across with are trade payable. So trade payable is what might be recorded in the debtor's account to show that there was a business that had occurred and we need to make a payment at some point in future. Then on the creditor side, the one who gives, we can find a record like trade receivable, which simply translates to there was a business transaction and we expect to receive money in future. The fourth type of transaction is contra transaction. So in contra transaction, there is movements of funds within the enterprise that do not involve inflow or outflow of funds as far as the enterprise is concerned. So in this, it can be the assets of a business moving from one account to another. It can be if the business withdraws money from the bank. Okay, so the bank account will have to give the cash account the money. So it has to be recorded that a particular asset has moved from the bank account to the cash account. So those are contra transactions. So just to add more light on the example that I've given, and another example, an example is the banking of cash taken from the office to the bank account of the enterprise, or withdrawal of money from the bank account of the enterprise to meet office expenses. So you get money put in the bank, that's a contra. Money hasn't moved out of the enterprise and no money has come into the enterprise. You get money from the bank for business usage. That's also a contra. Then the last one is barter transaction, which basically does not involve cash or bank. So this involves the exchange of goods for goods. Now let's take a look at the effect of transaction on the accounting equation. Every transaction affects two items on the accounting equation. Remember the accounting equation: assets are made of capital plus liability. Okay, so whenever there is a transaction, it can affect this and this, or this and this, or this and this. But there are also times when one item is going to be affected, but it's going to be affected twice. So it can be assets being affected twice. In the first scenario, the assets are going to increase. In the second scenario, the other type of assets are going to decrease. So in summary, sometimes it can happen that sometimes that this point here, every transaction affecting two items on the accounting equation, it can happen that it involves the same item being affected twice, once positively and once negatively, just like I explained. So these are the points we're going to use in analyzing the effect of transactions on the accounting equation. So we're going to take a look at examples. We're going to analyze different types of transactions. We're also going to analyze what item on the accounting equation is affected and how it's affected. So here we'll be writing the items that are going to be affected, and here we're going to write the effect or how they are affected. So here's the first transaction. Owner pays capital into the bank. So owner pays capital into the bank. So if we perceive this from the business point of view, the business had no capital, or maybe it had some capital, then it has received some more capital from the owner, meaning that the capital is going to be affected. What else? This capital has been put in the bank account, meaning that the bank is going to be affected. So bank is an asset, cash is an asset. Okay, so assets are going to be affected when the bank account is affected. The same is true for the capital. So assets in terms of the bank are going to be affected, and the capital is going to be affected. So how are assets going to be affected, and how is the capital going to be affected? Assets are going to be affected in this sense. Since money has been put into the bank, means that the total amount of money that was in the bank has increased. Therefore, assets in terms of the bank account or the money in the bank are going to increase. What about capital? So there was some capital, now more capital has been added. So it means capital is going to increase. The secret is to perceive all these transactions in terms of the business, like how do they affect the business. So you should see yourself to be the business and how this affects your assets, your liabilities, and your capital. So if the owner pays money into the bank, it means the capital that has been paid into the business is going to increase, and the money in the bank is also going to increase. The second transaction is buys goods by check. Buys goods by check. Okay, so initially, before this transaction had occurred, there was a certain number of goods. Now more goods have been bought. Goods are assets. So assets in terms of goods are going to be affected. But the payment has been made using a check. So the check means that bank facilities have been used. Therefore, the bank account is going to be affected. And the bank is also an example of an asset. So if the bank account is affected, it means assets in terms of the bank are affected. So we have assets in terms of the bank and assets in terms of goods. Now, these assets in terms of the bank, how have they been affected? Money has been used to buy goods, meaning that the amount of money that was in our bank account has reduced. Okay, so assets in terms of the bank have decreased, and assets in terms of goods are going to increase since we have bought more goods. The third transaction is buys goods on credit. So goods have been bought, but no money has been paid. What's going to be affected? First, assets in terms of goods are going to increase since there are more goods that have come in. What else is affected? Incongole, liabilities are going to be affected. Okay, so liabilities are going to be affected because buying goods on credit means that we're supposed to pay for those goods. We're having assets which we're supposed to pay to people who gave us those assets. Therefore, liabilities are going to increase, or incongruence is going to increase. So we have assets in terms of goods and liabilities both increasing. The fourth transaction is sale of goods on credit. Sale of goods on credit. Goods have been sold on credit. So assets in terms of goods are going to be affected. And also, you're going to have people owing you money. You're going to have debtors. A debtor is an example of an asset. A debtor is an asset. Okay, mean that assets in terms of debtors are going to be affected. Therefore, assets in terms of debtors are going to be affected, and assets in terms of goods are also going to be affected. How are debtors going to be affected? Since you have sold goods on credit, the number of debtors have increased. People who owe you money have increased. Therefore, debtors are going to increase, and also goods are going to decrease since you have sold them out. So assets in terms of debtors are going to increase while goods are going to decrease. Example 5. Sale of goods for cash. So you have sold goods for cash. What's going to be affected? So first, assets in terms of cash are going to be affected, and assets in terms of goods are going to be affected. This is similar to example number 1, just that in example number 1, we were using the bank, not cash. So assets in terms of cash are going to be affected, and assets in terms of goods are going to be affected. The goods are going to decrease since we have sold them, but the cash is going to increase since we have received the cash. So assets in terms of goods are going to be affected, and assets in terms of cash are going to be affected. So assets in terms of goods, they are going to decrease, and assets in terms of cash, they are going to increase. We go to number 6, pay creditors. So you are owing people money, so now you pay them out. What has been affected? First, assets in terms of cash, they are going to decrease since you have paid money. But also, your liabilities are going to decrease since incongore has been cleared. So assets in terms of cash are going to be affected, and liabilities. Assets are going to decrease, and liabilities are going to decrease. Number 7, debtor pays money owing by check. So this debtor has paid money by check. So the money has gone into the bank account. Mean that assets in terms of bank accounts are going to be affected, and they're going to increase since more money has been added in our bank account. Also, the assets in terms of debtors are going to decrease since the number of debtors have reduced since the debtor has cleared the balance. So assets in terms of the bank and also debtors. So bank increases, debtors decreases. Number 8, owner takes money out of the business bank account for own use. So the owner decides to take money out of the business for his personal use, not for the business use, for the personal use. So just pick yourself to be the business. Money has been taken out of the bank account. So the bank account has been affected. Assets in terms of the bank account have been affected, and they are going to decrease. What else has decreased? Here you can say capital has decreased, or liabilities have assets in terms of debtors have increased. So let's just analyze it further. So the first one, capital has decreased. This owner had put some money in the business, so they have withdrawn. If they assume they're taking part of their capital, well, then we can say capital is going to be affected as capital has decreased. It can also happen that the owner is thinking of paying back. If the owner is thinking of paying back, then he owes the business. He has to pay back, meaning that assets in terms of debtors are going to increase. But since here there's no guarantee of paying back, so it's going to be assets in terms of the bank are going to be affected, and capital is going to be affected. Assets in terms of the bank are going to decrease, and capital also is going to decrease. The last one is owner pays creditor from private money outside the firm. So this is an interesting one. So the business is unable to pay a creditor, so he gets his own money and he pays the creditor. what's going to be affected? So picture yourself as a business. There's money involved, but when that payment is made, is the cash that you have going to be affected, or is the money that you have in the bank going to be affected? Okay, so since this money comes from the creditor, comes from the owner, not the business, your cash account won't be tampered with and your bank account won't be tampered with. So what's going to be affected? First, after the transaction, the number of people the business owe money to is going to decrease. Okay, so liabilities are going to decrease. But that money that the owner has used to pay the creditor, it can be treated as an investment into the business as part of the capital, meaning that the capital is going to increase. Or it can be treated as another liability in the sense that the owner gives the business money, so the owner would need the money back. But in this case, it hasn't been stated if the owner needs the money back. So we can say that capital is going to be affected and liabilities are going to be affected. The capital, the money that the owners used to pay, can be treated as an investment, as additional capital. So capital is going to increase while liabilities are going to decrease. So this is how transactions affect the accounting equation. So this marks the end of this part. Happy solving.